And so that's why I believe that the $80,000 dip on Bitcoin recently is the bottom. And now we're going to have a supportive liquidity situation, at least marginally on the dollar, and we're bottom here and can go higher.
Bitcoin Zella stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now guess who keeps his eye on us? The author of best-selling book Rich Dad Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to Bitcoin Zella today and enjoy the new edge.
In this video, Arthur Hayes will talk about crypto's explosive 2026 outlook, and let's catch him to know more.
Well, I think if you take a look at, I have an index on Bloomberg if clients have access to that. It's the US dollar liquidity index, and it's essentially a combination of certain indicators on the Fed's balance sheet, which was published every week, and then certain indicators from the U.S. commercial banking system. And the reason why, at least in 2025, I've been really focused on the United States is the other three large money printing protagonists, the EU, Japan, and China, haven't really been doing all that much. And it's really been about the United States and everyone's reaction to what the United States has done. And so that's why I've really focused on this particular economic plot for, the whole year. And when we talk about the dollar liquidity, my chart basically showed that, year to date, there's been an actual reduction, a net reduction in the amount of dollars circulating, at least by my index that I look at, and I use to guide my investing over the year. But what we saw from sort of April 9th until, October was Bitcoin hitting an all-time high. And this was driven by, I think, people misunderstanding what's going on in the ETF space, especially the IBIT ETF, the BlackRock Bitcoin ETF, the largest ETF out there that tracks Bitcoin, and the digital asset treasury company space, the DAT space, and the issuance of debt and stock to purchase Bitcoin. And these two things essentially added the impression that there's this big institutional bid for Bitcoin. And therefore, the Bitcoin sort of ignored the fact that about $1 trillion was removed from the dollar liquidity markets at least from July until the present. And basically, once the ETF inflows switched to net outflows and DAT companies went from trading at premiums to trading at par, if not a slight discount, then Bitcoin basically fell down to where it should have been based on the dollar liquidity situation.
The crypto market may be facing a temporary pullback, but one major signal continues flashing green: the record-breaking supply of ERC-20 stablecoins. New research shows that even as prices dipped, the flow of capital into stablecoins has remained remarkably strong, preserving an all-time high of $185 billion. This level of internal liquidity hints that the market is far from losing momentum. Instead, it suggests a deep reservoir of ready-to-deploy capital waiting for the right moment to re-enter risk assets. Analysts from CryptoQuant highlight that stablecoin supply growth is proving to be a more accurate gauge of market strength than broad economic measures like global M2. Unlike M2, which adjusts slowly and has recently cooled, stablecoins react instantly to investor appetite. Their steady rise throughout 2025 signals fresh capital flowing into the ecosystem, echoing patterns seen before Bitcoin rallies in both 2021 and the 2024-2025 recovery phase. This trend is especially visible on Binance, where stablecoin reserves have surged while Bitcoin and Ether balances have dropped. Traders appear to be taking profits and sitting on significant liquidity, creating the conditions for a powerful rebound. With so much dry powder on the sidelines, even a modest price correction or macro improvement could ignite the next explosive leg of the bull market.
So in 2023 and in 2025, there is a political theatrical fight about the debt ceiling in the United States, where both, in 2023, it was the Democrats in charge. In 2025, it was the Republicans in charge. Same issue. One side wanted to spend a bunch of money and raise the ceiling. The other side tried to feign that they gave a fuck about fiscal responsibility, and so they fought the opponent. And then at the end of the day, of course, the government's not going to go bankrupt itself by not paying out. So they raise the ceiling. But all the while that this debate, this fight goes on, the Treasury has to spend down its checking account. And when the U.S. Treasury, or any Treasury department for that matter, spends down their checking account, they're adding fiat liquidity to the system. And so this is helps the markets. But as soon as the ceiling is raised, now the Treasury needs to refill its bank account. And by doing that, they issue debt. And instead of spending that money that they raise from the market, they keep it in the bank. And that extracts liquidity. So in 2023 and in 2025, it was June in 2023 and July in 2025, you had in the order of, half a trillion to $1 trillion that needed to be raised by the U.S. Treasury. And so as they start to do this, then the dollar liquidity contracts, and this has an adverse effect on all types of risky assets, Bitcoin and stocks predominantly. Now, in 2023, this led to sort of a 20% sell-off pretty quickly in the S&P. The 10-year yield was rising almost close to 5%. And again, the goal of every administration in the United States and every government around the world is to keep the stock market high because they earn taxes and makes the rich people feel good and all these sorts of things. So Janet Yellen had to find a way to juice the markets. Now, back in 2023, there was this facility at the Federal Reserve called the Reverse Repo Program, and it had $2.5 trillion of funds basically left over from the COVID stimulus era that was sat inert on the Fed's balance sheet. So what Janet Yellen did was said, okay, I'm going to issue more Treasury bills, short-term Treasury debt, less than 1 year maturity, and such a quantity that the yield is going to rise so much so above the reverse repo yield that it'll entice those funds to take that money out of the Fed's bank account and put it into the financial markets by lending it to the U.S. government, which then goes and spends this money. And so from 2023 third quarter until essentially January 2025, Janet Yellen's Treasury injected $2.5 trillion of liquidity into the U.S. dollar money markets, and that is essentially the reason why everything across the world ripped. Bitcoin, stocks, gold, housing, whatever, right? That is the reason for that bull market. And that sort of ended in early 2025. That's important because when U.S. Treasury Secretary Scott Bessent under President Trump in the United States did the same thing starting July 4th when the debt ceiling was raised. He had to raise $1 trillion to refill the Treasury's general account. He didn't have this reverse repo program with $2.5 trillion sitting in it to tap to basically nullify this negative liquidity effect. And so between that and the Fed's program of quantitative tightening, where they basically are reducing the size of their balance sheet, we're talking about close to $1 trillion was taken out of the dollar money markets from July to the present moment. And that is essentially the negative drag from a liquidity perspective on Bitcoin and other risky assets. Now, in the stock perspective, it's really the AI hype and bubble that's kept the stock market elevated. And in Bitcoin's case, it was the ETF flows and these DAT flows that we just spoke about that really counteracted this negative liquidity effect.
Raoul Pal is drawing a bold comparison between today's cryptocurrency landscape and the early boom stage of the world's biggest tech giants. He argues that Bitcoin in 2025 resembles Google in 2017, a network already dominant, widely adopted, and clearly powerful, yet still miles away from realizing its full potential. At that point, Google had conquered search and advertising, but had only begun to tap into cloud computing, AI, and broader data-driven services. Paul believes Bitcoin stands in a similar position. Its network is thriving, global adoption is climbing, and its role as digital money and collateral is expanding. But the true scale of what it can become remains underappreciated. Ethereum, Paul suggests, is at an even earlier point in its life cycle, echoing a prematurity phase where utility, innovation, and network size are growing at an accelerating pace. He emphasizes that both assets behave like classic network platforms, where value stems from scale and user interaction rather than traditional cash flows. Using Metcalfe's law as the foundation, he stresses that adoption alone drives exponential growth. Much like Google, Meta, and Amazon built immense value from their user bases, crypto networks thrive on participation. For Paul, dismissing these dynamics means missing the very mechanism that makes Bitcoin and Ethereum so powerful. If you have been watching so far, thank you so much for watching, and do not forget to subscribe to Bitcoin Zella for daily news all for free. That's all for today's video. Until next time.